Jake buys a rental property. Marcus puts the same money into gold. They both think they just made the safest investment of their lives. They're both wrong, and because one of them is about to lose money every single month, and the other is about to learn what happens when your investment can't earn a single dollar on its own. When you run the real numbers over 20 years, both of them owe each other an apology. Let's keep this fair. Jake and Marcus both have $50,000 saved. Same age, same city, same salary. $55,000 a year. The only difference is what they do with that 50 grand. Jake uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom in a decent neighborhood. He takes out a 30-year fixed mortgage at 7% interest. His monthly payment lands at about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit before he's spent a single dollar on anything else. Jake feels like a genius. Marcus takes his $50,000 and buys gold. Physical bars, a gold ETF, doesn't matter. He puts it all into the one asset everyone calls safe. No mortgage, no tenants, no phone calls, no leaking roofs. Marcus checks his portfolio once a month and does absolutely nothing. Same money, same starting line, completely different bets. For the first few years, Marcus looks like the smart one. Gold is surging. Inflation fears, global instability, central banks buying at record levels. In a single year, gold jumps 25 to 30%. Marcus's $50,000 is suddenly worth $63,000, maybe more. He didn't do anything. He didn't fix a toilet. He didn't screen a tenant. He didn't get a phone call at 2 a.m. about a broken pipe. He just sat there and got richer. Meanwhile, Jake is living in a different reality. His first tenant trashes the kitchen and moves out after 8 months. It takes Jake 6 weeks to find a replacement. That's 6 weeks of zero rent. But the mortgage doesn't stop. Neither do the property taxes, insurance, or the $3,200 HVAC repair that hits in month 4. When you add it all up, mortgage, taxes, insurance, maintenance, vacancy, Jake's actual cash flow in year 1 is negative. He didn't make $470 a month. He lost money. Every single month, Marcus's phone hasn't buzzed once. His gold is up 30%. He's starting to feel sorry for Jake. But here's what nobody tells Marcus. Gold produces nothing. Zero income, no rent, no dividends, no interest, no yield. It just sits there. A shiny brick that doesn't send you a check. The only way Marcus makes money is if the price goes up. And if it doesn't go up, he earns literally nothing while inflation quietly eats his purchasing power. And that's not a hypothetical. From 1980 to 2000, 20 full years, gold lost value. Not underperformed, lost value. If you bought gold at its peak in 1980, you didn't break even until 2008. That's 28 years of holding an asset that gave you nothing. Now, Marcus didn't buy in 1980, but he did buy near an all-time high. And historically, that's a dangerous entry point for gold. There's also the tax problem. The IRS taxes gold as a collectible. Not like stocks or real estate. That means a maximum federal capital gains rate of 28% compared to 15 to 20% for most other investments. So even when gold does go up, Uncle Sam takes a bigger bite than he would from almost any other asset class. And the long-term numbers? From 1971 to 2024, gold averaged about 7.9% annual returns. Stocks averaged 10.7% over the same period. Real estate with leverage often did better than both. Gold's recent run has been incredible, but incredible runs are exactly what make people forget the decades when gold did nothing at all. Now let's be honest about Jake's side too. That $470 a month in profit was a fantasy from day one. Here's what Jake's real monthly costs look like. Mortgage, $1,330. Property taxes, roughly $250 a month. Insurance, about $100. Maintenance and repairs. The industry rule is 1 to 2% of the home's value per year. On a $250,000 property, that's $2,500 to $5,000 a year, or $200 to $400 a month averaged out. Vacancy, the national average is about 6 to 8% of the year. That's roughly 1 month of zero rent. And if Jake hires a property manager, that's another 8 to 10% of collected rent for us, about $150 to $180 a month. Add it all up, and Jake's real costs are somewhere between $1,880 and $2,260 a month, against $1,800 in rent. That means in the early years, Jake is either breaking even or losing money every month. And that's before a single surprise hits. And surprises always hit. A new roof, $8,000 to $15,000. An HVAC replacement, $5,000 to $10,000. A bad tenant who stops paying and takes 3 months to evict. Priceless. And not in the good way. If Jake self-manages to save on the property management fee, he's trading his weekends, his evenings, and his sanity. When you divide his actual net profit by the hours he puts in, he might be earning less than minimum wage. Real estate isn't a passive investment. It's a second job that people keep pretending is an asset. By year 3, something starts to shift. Gold's initial surge cools off. This is historically normal. Gold tends to spike during fear and then flatten or decline once the panic fades. From 2012 to 2019, gold went essentially sideways. 7 years of holding an asset that produced no income and no growth. Marcus is now sitting on an investment that isn't growing and isn't earning anything. Every year, inflation is chipping away at his purchasing power. His $63,000 in gold still buys less than it did 3 years ago in real terms. Jake, on the other hand, is grinding, but the numbers are slowly turning in his favor. Rent doesn't stay flat. It tends to rise with inflation, roughly 3 to 4% a year. By year 5, Jake's tenant is paying about $2,000 a month. By year 8, it's closer to $2,250. But his mortgage payment? It's fixed. It's the same $1,330 it was on day 1. That gap between rent and his fixed mortgage keeps widening, and more of each mortgage payment is going toward principal, not interest, which means Jake's equity is building faster every year. The property itself is appreciating too. At a conservative 3.5% annual rate, Jake's $250,000 house is worth around $295,000 by year 5 and roughly $345,000 by year 10. Jake still has the headaches. He still gets the calls, the repairs, the tenant turnover. But the math is no longer underwater. He's cash flow positive, and his net worth is climbing. Marcus is doing nothing, which was the whole point, but nothing is exactly what he's getting back. Now let's zoom out and run the full numbers. Jake's property, appreciating at 3.5% per year for 20 years, is now worth approximately $490,000. His mortgage balance after 20 years of payments is down to about $128,000. That means Jake has roughly $362,000 in equity in a property he bought with $50,000 down. On top of that, Jake's been generating positive cash flow for the last 15 years. Even after subtracting all his real costs, every repair, every vacancy, every tax bill, his cumulative net rental income over 20 years is somewhere between $60,000 and $100,000. Total position, roughly $420,000 to $460,000 in combined equity and cash flow. Now, Marcus, if gold follows its long-term average of roughly 8% per year, which is generous considering he bought near a peak, his $50,000 is worth about $233,000 after 20 years. That's it. No income along the way. No tenant checks, but also no rent checks. Just price appreciation. And after the 28% collectible tax on his gains, his after-tax position is closer to $182,000. Jake, $420,000 to $460,000. Marcus, around $182,000 after taxes. And the reason the gap is that wide comes down to one word: leverage. Jake used $50,000 to control a $250,000 asset. That's 5-to-1 leverage. Every dollar of appreciation works 5 times harder. Marcus used $50,000 to control $50,000 in gold. No leverage, dollar for dollar, that's it. When the underlying asset grows, leverage is a rocket. And over 20 years, Jake's rocket had time to reach orbit. If I only showed you the downsides of gold, I'd be doing what every real estate influencer does. So let's be honest about Jake's side. Real estate is illiquid. If Jake needs $10,000 tomorrow, he can't sell a bathroom. He either takes on more debt or he sells the entire property. And that takes months. Transaction costs are brutal. When Jake eventually sells, he's paying 5 to 6% in real estate agent commissions, plus closing costs, plus potential capital gains taxes. On a $490,000 property, that's $25,000 to $35,000 gone before he sees a dime. Concentration risk is real. Jake's entire investment is one property in one neighborhood, in one city. If the local economy tanks or a factory closes or a flood zone gets redrawn, his net worth takes a direct hit, and the time cost can't be ignored. Over 20 years, Jake spent thousands of hours managing, repairing, screening tenants, handling emergencies, and worrying. That time has a value, and it never shows up on any balance sheet. Real estate builds wealth, but it demands something in return. And if you're not willing to pay that price in time and stress, the numbers don't work nearly as well. Gold isn't a bad investment. It's a bad strategy if you treat it the way Marcus did. Gold wins when you use it the way it's designed to be used, as a hedge, not a centerpiece. In 2008, when the stock market crashed 37%, gold went up 25%. During COVID, gold surged while everything else fell apart. When inflation spiked in 2022 and 2023, gold outperformed most asset classes. If Marcus had put 10 to 15% of his portfolio into gold and invested the rest elsewhere, stocks, real estate, bonds, he'd have gotten the crisis protection without sacrificing 20 years of growth. Gold also wins on simplicity. No tenants, no maintenance, no property taxes, no 2 a.m. phone calls. You buy it and forget it. For someone who wants zero involvement in their investment, that's worth something. And in countries with unstable currencies, weak property rights, or political instability, gold isn't just an investment, it's survival. It's portable, universal, and it doesn't depend on any government to hold its value. The problem isn't gold. The problem is going all in on any single asset and calling it a plan. Neither Jake nor Marcus was wrong about what they chose. They were wrong about how much they chose. Jake went all in on a single illiquid asset that demands his time, his money, and his patience every single month. He got leverage, cash flow, and appreciation, but he paid for every dollar of it. Marcus went all in on an asset that produces nothing. No income, no yield, no compounding. He got simplicity and crisis protection, but he gave up 20 years of earning potential to get it. The real trap isn't gold or real estate. It's treating either one as your entire strategy instead of understanding what role each one actually plays in a portfolio. Gold is armor. Real estate is a machine. You don't wear a machine into battle, and you don't put armor to work in the field. Use them for what they are, and the math starts working for you instead of against you. And if you think stocks would have beaten both of them, you might want to watch our video on stock versus real estate, because we already ran those numbers and the answer isn't what most people expect. And if you're wondering how gold stacks up against the stock market on its own, dollar for dollar, no leverage, no tenants, just pure returns. That one's coming next. Subscribe so you don't miss it.